Hey everybody, welcome to Retire with Style. I'm Alex and I'm here with
Wade.
Foul and we're
Mhm.
getting ready to roll another one. Wade, what are we going to talk about today?
We're going to talk about a very popular topic on if you ever read an article on Yahoo Finance or anything like that about the 4% rule and then read the comments, you'll read a number of comments that say, what is this 4% rule nonsense? I've put together a portfolio of dividend paying stocks giving me a 6% dividend yield. The 4% rule is meaningless. And so we're going to be talking about this idea of investing for income, leaning into higher yielding dividend paying stocks, or with bonds, it's the same sort of conversation around higher maturity, longer maturity, or credit risk to seek out a higher yield, and how that may not ultimately really create additional value for the retirement plan. It's popular in comment sections on finance articles, but it's not been an issue that's been really analyzed or explored in terms of the historical data in the same way that the 4% rule has. And where economic theory really points to the idea that no, there really shouldn't be anything there. Leaning into higher yielding stocks and bonds should not give you a higher withdrawal rate for retirement.
Got you.
That's
And
the
just
basic matter.
and just to recap this way, this is also part of the previous stuff that we've been talking about where we got into why 4% rule may actually be too high. And so this episode, it's nothing really against the 4% as it relates to the total return, but a lot of folks take this 4% rule and impose upon it a dividend strategy to get that 4% or even higher, as Wade pointed out. Correct?
Right. We're in a series of probably 3 episodes talking about why the 4% rule might be too high. Or what that really means is where when you change assumptions behind the 4% rule, you might end up with a lower withdrawal rate number. Now, later on, we'll talk about there's a whole host of reasons why the 4% rule might be too low. But in particular, today, what we're talking about is the 4% rule assumes you have a total market portfolio. You invest in total market stock and bond indices. You invest for total returns. You don't worry about the breakdown between cash flows kicked off of the portfolio and the selling of principal to fund retirement expenses. And the violation of that assumption that we're talking about today is no, you move away from total returns, you lean into higher yielding assets
Wow, Wade,
as a
the word
way
violation. That sounds serious.
violating the assumptions.
Yeah. Why do you think this is just anecdotally based on your experience reading it? Why do you think it's such a popular idea? Income investing, investing for dividends, investing for yield, as opposed to thinking the portfolio as a whole, or whatnot. What's your take on that?
Well, I think it can just intuitively sort of make sense that if I can put together a portfolio that's kicking off 6% income and I never have to sell a share, why wouldn't that be a better retirement strategy? I just think intuitively it sounds appealing. Now, the issue is it actually going to work better? But I think intuitively it sounds good.
Yeah, no, I've debated that myself. Oh, what do I think? Oh,
Yeah, what do you think? Yeah.
no, I actually I agree with you 100%. I also think it's one of these things from a bygone error. Oh, I don't know which word is appropriate. Maybe
Era.
both. Era. And by that I mean, when stocks really used to kick out dividends a while back, many times it was higher than bonds, and at a certain point it kind of flipped the other way around. But it seems to me in the old school way, investing was just thought like that. Get good quality stocks that kick out a dividend, and from that dividend you get your cash flow. I don't see that to be the case that much anymore, but there's something there that has remained. And frankly, I think the Wall Street uses that, and many advisors use that, and many reporters use that as almost like a gimmicky is too strong of a word, but almost like a way to get eyeballs or to attract certain strategies that, from an economic standpoint, there's nothing wrong with them, but by the same token, there's nothing good with them either. By good, I mean, there's nothing above and beyond why you should use them relative to other strategies. If anything, it limits the purview of potential other investment strategies we'll get into. But we see this quite a bit. This whole investing for income versus just a total return approach.
Yeah, I think there could be a behavioral piece too, where people generally don't like having to spend down their nest egg, or they don't like to sell shares to fund retirement expenses. And so behaviorally, it kind of feels like the whole idea of spending your paycheck. Well, if you put together a portfolio that's providing you this paycheck of interest and dividends, you're not having to sell shares. There could be a degree of comfort in that, a reassurance that I'm not going to spend down my assets because I'm not selling my assets.
I get you.
And so certainly that could be part of it as well.
So wait, if you don't mind though, taking us through the calisthenics of why do we say that there really is no benefit from taking income in the form of dividends versus just creating your own dividend by just selling shares yourself to raise cash. Why is that? Why is there no benefit one way or the other?
Well, it's a basic finance theory. Kind of the value of a stock is the present value of its future dividends. And I don't know if this is always commonly or always understood, but when a dividend is paid, the stock price reduces by the amount of the dividend. Now, at the end of the day that the dividend is paid, that may not be an exact thing because there's capital gains and capital losses going on every day. But the stock price falls by the amount of the dividend. And that's where nothing in a pure economic sense has changed between having a higher price stock that didn't pay a dividend or a stock that reduced in price by the amount of the dividend paid.
So that's important. If you had, so you think about what Wade is saying, if you had 100 shares of a stock and they're priced at $20, you effectively have $2,000. That your portfolio is worth $2,000. Now you can sell a certain amount. You can sell $100 worth of it, and there you have it. But let's say these stocks, you have 100 shares and they issue $1 in dividends. All of a sudden that price goes down to $19, and the company has effectively kicked out to you by $1 a share per dividend, $100. So it's effectively the same thing. So you shouldn't. There isn't one. The $1, either if it comes through dividends or if it comes through capital gains, is economically the same, not without any tax considerations. I'm not, ordinary dividends versus qualified dividends. I'm not going to get into that right now, but that's depending on your holding period. But effectively, it's the same economic transaction.
Right, without taxes. And that's the other thing. I mean, taxes actually weaken the case for the dividend-paying stocks, but ignoring taxes, it doesn't really matter how you extracted that portion of your asset, whether it was through a dividend or whether it was through selling shares. You have the same number of shares, but they're worth less after the dividend is paid.
Yeah, so conceptually, what really is going on there, and that's where we want to make sure that you're making the right decisions. And so when you get presented with these dividend strategies, with these sort of things, I'm not sure they're necessarily an improvement versus what could be done from a total return standpoint. And I would go so far as to say, as you're limiting your opportunity set in which you can extract ongoing equity premiums over the long term. Now that's as it relates to stocks. Real quick, in terms of bonds, we see this a lot in McLean, where someone comes in with these bond portfolios, especially as returns have, as yields have gone down, although they're heading back up, where over the long term, there really is a little bit of a premium for maturity, for extending maturities. But once you get past a certain point, there's not much there. And there is a little bit of a term premium, but it's nothing to go crazy about, right? And so the danger that happens is there's this desire to start chasing yield. There really is. When you start when you start thinking about it in terms of mental accounting, like yield, this bond is going to give me 5%, and you know what? That's 1% over the 4% rule, so that's a heck of a deal. There's a danger to do that, and ultimately, what happens is you're really taking more outsized risk than you wanted to begin with. Now, this is separate from time segmentation, where you're matching liabilities exactly. This is where we're sticking to the total return, probability, safety, for probability, optionality side of the quadrant right now. And so from that vantage point, fixed income should serve as more of a ballast and it shouldn't even be a consideration from the standpoint of taking distributions from it or not. It really serves as a ballast to the equity portion. So you really want to sort of watch yourself when it comes to that. Uh, Wade, I've heard you say this, and it merits saying it again. What's an analogy that folks use that I think I heard it years ago, and I've never forgotten it, and I use it quite a bit when it comes to earmarking dividends versus a total return approach. I'm thinking precipitation here. How does that analogy go? Because I think that's something that really hits home whenever I hear
it. I'm not exactly sure what analogy you're referring
to. Oh, really? The one about the well? I'm sorry, like water from a well.
Oh, it's new to me.
Oh, really? Oh, I thought. Okay.
Why don't you tell us this analogy?
I was trying to set you up, Wade. No, effectively, if you think about it like this, dividends. There's many ways you can create a distribution amount, right? You can get it from wherever, right? So think about water in a well. Right, you're taking water from a well, so it's very similar to taking sustainable distributions, right? You don't concern yourself when you're taking water from a well if the water came from snow, if it came from rain, if it came from morning dew or whatnot. You just are concerned that there's water there. You don't have a special bucket that's just going to pick up rainwater, a special bucket that's just going to pick up snow, a special bucket that's just going to pick up morning dew or whatnot. You're just taking it from the well. That's the way I view the ability to take sustainable withdrawals from a portfolio. I'm less concerned. I'm not concerned at all, frankly, whether if it's coming from a dividend or it's coming from capital appreciation, and I'm just cutting a slice of that appreciation for myself. And that's a better way of looking at this than to getting into the game of mental accounting with dividends. Now, some of you may point out, well, there's been studies about this. Right, there's been studies about this, how they do relative to others. I mean, popular book was The Dividend Aristocrats, things along those lines. And what you'll see over the long term, that there is no above average return provided by dividend stocks relative to the factors that they are naturally exposed to. And what I mean by that is, you're able to assess how much value stocks bring to the table, or what the expected return is of a stock based on a few factors, right? Their market beta, their exposure to size. Small cap stocks tend to outperform larger cap stocks. Their exposure to value stocks tend to outperform growthier stocks. Their exposure to momentum, their exposure to a quality factor, which is a relatively new one. And this determines roughly 95-98% of the expected variability of all stock market returns. And so when you look at dividend stocks, they have a little bit more exposure to quality. They have a little bit more exposure to value, but you can capture that passively without having to go all into dividend stocks. And so a way of saying that there's many stocks in the stock market that have these types of exposures that don't provide dividends, but they have the same expected return as dividend stocks. So why would you reduce your opportunity set within the investable universe by just focusing on dividend stocks? It would be akin to, there's stocks A through Z. They all have the same expected return, but you know what? I'm going to invest just in stocks A through M, and stocks N through Z I'm going to forget about. Why? Because they don't start with the letter A through M. That really is the case. There's no above and beyond reason why a dividend stock will outperform other stocks that have similar exposures to these risk factors. Wade, you want to go into that a little bit?
No, I think that makes a lot of sense. And it's, again, what I've also seen kind of explained about this is when you lean towards yield, you're trading current income for risk to future income, because like you're saying, you're moving away from the total market portfolio. Now, the total market portfolio pays dividends and interest. It's just they may be lower than the spending goal. And that's the difference is, when you shift away from the total market portfolio, lean into dividend paying stocks or higher yielding bonds, you're moving into riskier sectors of the market ultimately. And you might get more income today, but if the total returns are equal or less than the for this subsector of the market that you're going into, over the long term, you're not going to be in a better position. A lower total return doesn't matter how high the dividend yield is, you're going to spend down that asset base quicker. And that really is the concern with these sort of income investing type strategies.
No, and you're absolutely right, and there's risk. There's risk in the concentration factor, in from a concentration point of view. And again, I believe I said it earlier, but like 60% of U.S. stocks do not issue dividends. 40% of international stocks don't pay dividends, and so you're really excluding them. And so you could say, well, I don't need that, but if I get 10 good dividend paying stocks, then I feel good about that. Or if I get 20 good dividend paying stocks, then I feel good about that. And now then it's just basic portfolio construction 101. As much as you feel good about the dividends, I mean, you're taking an exorbitant amount of risk relative to your retirement safety to put your whole entire income strategy on just 10 stocks or 20 stocks or what have you. And at that point, ignore all the studies that Wade has done on the 4% rule, or that, we've just brought up, because the reality is it doesn't apply if you just have 10, 20 stocks. I mean, it's hard enough to get a sustainable withdrawal rate with 3,000 stocks, right, Wade? I mean, you want to...
Right, maybe... you're not using the assumptions of the 4% rule. There's the tracking error. You're not... The 4% rule is based on total market portfolio returns. You're not using that assumption, so you can't rely on that research to know what a sustainable spending strategy would be.
Because you're not diversifying away from company risk at that point. And that's a risk that you're not necessarily compensated for. And we can't, it's too much noise at that point to really make any conclusions with regards to what the sustainable withdrawal rate is. And that's very important. I mean, you can take these assumptions, but it really goes down to having a market portfolio. And that was one of the reasons why in the previous episode we said, why may it be too high? A 4% rule may be too high because investors kind of muddy things up a bit. And this is one of the prime ways to muddy things up, where you sort of think to yourself, well, you know what, I'm going to back into a 4% rule by looking at dividends. And if I get stocks that effectively pay 4% and it's 30 of them, so I'm diversified. Not really. You're diversified in the sense that maybe the standard deviation equates to what the market standard deviation is, but the tracking error is going to be immense, and the opportunity cost is, you're not going to be diversified across all the industries, et cetera, et cetera. And so it's troublesome there. And by concentration, ask yourself, what are the companies that issue dividends? And again, there's nothing wrong with dividends. We don't want to sort of paint them in a bad picture. It's just, when you're trying to capture market returns, you have to expose yourself to market returns. And these sustainable withdrawal rate strategies are based on capturing market returns efficiently. Another thing, Wade, that I just wanted to point out is there is, and you pointed out there's a little bit of a behavioral sort of thing going on here. And it's interesting because there's been studies by Schefferin and Statman that really begins to point this out, because I think what you were referring to is there is no economic reason why a dividend is better than just taking, selling and taking the gain and creating your own dividend. There shouldn't be one better than the other, if you will. Well, I would say the total return is better, but the economic, the dollar is the same from any pile, right? And Schefferin and Statman point out, and I don't know, I don't have enough conversational backdrop to point this out, and I think they're just posing this as well. But it's an interesting concept, and what dividends do provide is this ability to control spending a little bit. What they start saying is, well, you know what, we have trouble as human beings delaying gratification. I only have that problem with marshmallows on a table, but that's it. No, human beings have trouble with delaying gratification. And so what a dividend policy does is it kind of does it for the person. It kind of just, the person doesn't really have to sell. The person doesn't have to buy. He just stands back and waits for that dividend check to come in cash and takes it. And so it's really a matching of a cash flow piece that seems to kind of have a lot of interest with folks in terms of doing that. And that may be, I'll take it a step further, that may be maybe why sometimes folks get an advisor, because they effectively function as that person cutting that check and sending it to
Mhm.
them where the person doesn't have to do anything themselves. What do you think about that, Wade?
Yeah. For somebody who's, I mean, there's many examples of this kind of. I'm worried about overspending. I don't feel like I have the willpower to control that, so I might just overpay taxes as a forced way to get that tax refund that I'll then save. Or in this context, I don't have the self-control, but if I can just frame things as I'm allowed to spend my dividend and I'm not allowed to sell any shares, that could be a way to just create that the behavioral commitment, the general idea of, okay, this is how much I'm allowed to spend. Now, you could deviate and spend more, but at some level, you kind of just, okay, here's a rule that I'm going to apply to my situation. I'm allowed to spend dividends. I'm allowed to spend interest. I'm not allowed to sell shares. And that can help me to avoid overspending. So
Saves
I
your
can imagine that some people might employ that sort of behavioral trick, and that might be why they liked dividends and interest from their
sort of to save you
portfolio.
from profligacy to some
Right.
extent. I don't know. I mean, the way I would see it and the way I've spoken is, to me, it's like allowing a board. Let's say these companies are made up of boards, and the boards, implement dividend policies. It's like allowing a board to kind of determine what your income should be, and this board knows nothing about you. And I'm like, why would you do that? I mean, I got past my allowance, when I was, I don't know, at 10 years old, right? After that, I can manage. It's one of those things, but yeah, I guess it helps for some folks, and this is where I think it still goes back to that old way of thinking. And by old way, I don't mean like this is your dad's Oldsmobile or this kind of stuff. I just think it's a bygone era where it was kind of a known way, but science moves forward. Through much of the research, Bagman, through Wade's research, there's ways that point out there's optimal ways to do this from a total return strategy. And if you're agnostic, and as you should be, to where the money comes from, think about the precipitation example. It shouldn't matter at all. I mean, I think you do yourself a favor by just getting out of that mindset, frankly, because it's mental accounting that can be very tricky. Another
Mm-hmm.
another thing that these guys point out, Wade, is that
Yeah.
okay, that's from the I'm going to give you guardrails, so spend what your dividend is, and that's quote unquote your allowance. But there's a loss aversion piece to this that that is interesting as well.
Yeah, that people don't like experiencing losses. And if I'm investing with a total return portfolio and the market is down, that could force me to realize a loss that makes me very sad. the dividend investing well, the dividend investing approach kind of gives you a backdoor to not have that mental image, because the market may be down, but I'm just spending my dividends. I'm not selling at a loss. I don't have to deal with the psychological dissatisfaction of selling at a loss,
But
because I'm
again, going
spending my
back to what you
dividends.
said at the beginning, it's really the same thing because the dividend reduces the price per share by the dividend amount. So it's kind of a funny thing. You really are, but you're not. That kind of thing.
Yeah, and it'd be interesting if economists always like to come up with these explanations that intuitively makes sense, but whether or not people are actually, they may not even necessarily verbalize it, but they're implicitly behaving this way. It's just internally, this is what they're doing. I don't know. It seems kind of like a stretch, but maybe
No,
there's something to
I
it.
see this a lot. I see this with prospects coming in, not necessarily clients, because clients, if they are going to be in the total return approach, it is a total return approach. We don't have like a dividend strategy. There are some firms that do that, and they give it some acronym to sound all fancy, or kind of like this is our, intellectual property dividend lever strategy. And
Oh, yeah.
I think that's a load of garbage, honestly. No, it is. I think it's just done to kind of appeal to your behavioral sensibilities, but there's nothing. There's no there, unfortunately. And we don't do the hand over our heart. We're not going to do something just for that. We're going to do it if it makes sense from a planning from the planning standpoint. And so I do think there's a lot there, because if you're just collecting dividends, then you can say to yourself, well, I'm not really spending down principal, right? In case you had started a 4% rule, right? The other piece is if it goes up, even better, right? It's like everything is gravy. You're playing with the house's money. But again, if it goes down, you don't feel like you're selling at a loss. And going that losses have a greater emotional valence than gains. I do think that has something to do with it. That sort of regret avoidance, if you will. But again, there's this is in this episode there's a couple of points we really wanted to hit home on, because this is something that it comes up a lot. It comes up a lot. You're going to read it. There's going to be some guy writing some book, or woman writing a book about dividends, or an article about it. And it shouldn't matter. It really should not matter. The reality is there's three main points. $1 in dividends versus $1 from selling an asset is the same thing. It's irrelevant. And frankly, you have more control of it when it comes via a total return approach. Frankly, we're all about being agnostic versus strategy and so forth. But a strong case is made that a total return approach is just a better option for you than matching it to dividends. The second point,
and we hinted at the tax issue too, that we never really got much in depth with. But if your dividend is all the qualified dividends that are taxed at preferential rates, and you're spending it, because with any sort of retirement withdrawal strategy, you'd spend any dividends and interest first. And then if you needed more income, you'd sell some shares. So if it's all tax at qualified dividends and you're spending it all, it doesn't really make a difference. But if you're receiving more dividend than you might actually want to spend, even with a qualified dividend, you're still front loading taxes because you're having to pay the tax on it, and then you might reinvest it. Whereas if it was unrealized long-term capital gains, you could defer the taxation longer.
That's exactly right.
When you overlay taxes, the dividend strategy looks less helpful in that regard.
That's exactly right. And so that's the first point. And again, if you had to think of the analogy, that's sorry to put you on the spot at the beginning, Wade, but it's effectively that well. Think about withdrawals as precipitate water. You're taking water from a well. You don't care about the sources of precipitation. You just care that the water's there, right? Same thing. You don't care if it's snow, rain, or morning dew. You just want water. Same thing when it comes to sustainable withdrawal rates, whether it comes to the dividends, capital gains. As long as it's sustainable, you're golden, because economically, it's the same thing. The second point is there is no extra added return for investing in dividend stocks versus investing in stocks that are exposed to the same factors that do not pay a dividend. There's no magical pixie dust on top of dividends. All right. Effectively, the expected return, the expected return of any stock could effectively be explained by their exposure to the market, their stocks, their exposure to size, their exposure to value, their exposure to momentum, their exposure to quality. So those stocks are plentiful within the market. And so why restrict yourself to just the ones that have dividends? That reduces your opportunity set, and it creates concentration that you don't need. And then it violates effectively the sustainable withdrawal rate strategies that we've been discussing. It just does. And the third one is there's a strong psychological component here. The first one being that, it creates this ideal that you're not selling principal. You really are, though. Not that you really are, but economically it's the same. So you need to disabuse yourself from that, because it doesn't jive. It doesn't jive from that. And, you're not selling principal. And the other piece is you're giving yourself kind of an allowance. These companies then, through dividends, that's your allowance. So it kind of gives you that idea that, I'm not going to spend more than what I get in dividends. So those are three reasons right off the bat why, for us, I think when you get so focused on dividends, you start losing the forest for the trees here a little bit. Wade?
Yeah, that's right. And we mostly focused on the stock side. We paid a little lip service to bonds, but it's the same situation there too, that if usually there's an upward sloping yield curve, which just means longer term bonds have a higher interest rate than short term bonds. But that's in large part because long-term bonds are riskier. A small increase in interest rates is going to lead to a bigger loss on a long-term bond than a short-term bond that could wipe out any of that additional yield quite quickly. And then with credit risk, it's, you're just taking on more risk, like junk bonds or whatever the case may be, where you're seeking the higher yield. That is going to lead to more volatility and not necessarily give you the kind of performance that you're really looking for in the long term.
You're 100% on target here, and you're right. We kind of bonds are boring, right? So we kind of always just get lip service a little bit. But what Wade is saying is very, very true, and I think more people actually come up to us with portfolios that are searching for yield on the credit side than on the high dividend side. And so from this vantage point, another way of saying what Wade is saying is term premium, which is the longer out you go, the higher technically you'll get a yield. But it's not that much. Once you get past 4 or 5 years, from a risk return, from a return relative to the standard, relative to the volatility that underlying holding has, it's not worth it. It's actually less than what you would get from a efficient model kind of asset. It's actually very poor, extending maturity. So it's not worth the extra bump in yield relative to the risk you're taking, even though you may say to yourself, it's a bond. It doesn't matter, especially, go on.
Well, that's come up in past episodes too, where like all of the Bill Bengen style research on historical data, it's intermediate term U.S. government bonds were the sweet spot, supporting the highest withdrawal rates historically, and that's about a 5-year maturity.
Yeah, once you get
past that, the volatility doesn't compensate for the too much. I mean, the yield doesn't compensate for the extra volatility.
Now you may ask yourself, well, why do they have bonds going out that long? Who would buy them? Those are people that are trying to do different things with their portfolio, like insurance companies trying to immunize their liabilities in the future, et cetera, things like that. The other piece is credit. Oh, I'm going to go, instead of AAA, I'm going to do AA. I'm going to do whatever, right? And again, this is in the frame of mind of total return. And so here, fixed income should, again, be seen as the ballast to your portfolio. If you're doing a total return, you shouldn't try to think, okay, I'm going to take this from fixed income, this from stocks, because it's the whole well example again. It's precipitation, right? And so what happens with credit premium, you may think everything is good, but what happens is over the long term, when there's moments of dislocation, and that's another way of saying stuff hits the fan, when things just go all out, it's really the high quality, high credit stuff, short term, that really remains. The other stuff starts acting a lot more like equities. So all these years that you thought you were getting this sort of, faux safety returns, it just takes 1 6-month period, one week period to just blow that all up. And that's why you don't get this sort of efficient risk return trade-off either for extending not just term, but credit quality. And so you don't want to do that within this dividend mindset, because it's very easy to fall into the trap of, hey, this AAA corporate bond or whatever is paying 4%, but this BB is paying 7%. Hey, it's only one letter. You know what? I'm getting it. That kind of, no, you don't want to do that at all, because it's when you need that security, dislocation occurs. And where are you at that point? Then, okay, you still have that dividend, but the actual value just dropped, by orders of magnitude. And there it is. Now, we wanted to take time. We were thinking, Wade and I were debating, okay, do we include this as a bunch of others? We wanted to just take time and just discuss this one alone, because we feel it's important. This is something that comes up quite often in terms of this dividend dedicated portfolios when it comes to total return. And so Wade, I feel good about everything we've discussed. Is there anything we may have missed?
No, I think we covered it. And so kind of leading into the next episode, we'll have one more on why the 4% rule might be too high. And that relates to the 4% rule ignores taxes. It assumes you're willing to spend your assets down to zero, and it assumes just 30 years, which may not always be a long enough time horizon. And then after that, we'll get into why the 4% rule might be too low. But
yeah, we'll be optimistic.
This was an important. This is an important topic that actually doesn't get a lot of coverage, other than people always just saying, "Well, I invest for income, so this whole 4% rule conversation is nonsense." And so it was worth unpacking that a little bit today. So thank you for that, Alex. You're the one who pushed to have more of a unique episode on this topic. So it was a good idea.
All right, Wade. Well, thank you, everyone, and we'll catch you next week, right?
Yep, thanks. See you next week.
Bye.